Today, we will talk about impact of technology on financial markets. Recent cutting-edge technologies, such as machine learning and artificial intelligence, as well as the expansion of fintech and big tech companies into finance, have accelerated the digitalization of financial services. The fourth report in the Future of Banking series from the IESE Business School and CEPR focuses on three aspects: the disruption of payment systems due to the emergence of digital currencies, with a particular focus on central bank digital currency, the benefits and risks of the use of massive data for the provision of financial services, and the electronification of securities trading and its effect on trading costs and market quality. The financial system serves many important functions, including the provision of payment systems for exchanging goods and services, the production of information, and methods to share risks and allocate capital efficiently. Merton, 1995. The financial system and banking institutions have faced several challenges in the last decade, including a new regulatory environment, the consequences of the COVID-19 outbreak, and the transformation of their business models towards a net-zero carbon economy. These issues have been analyzed in previous reports on the series on the future of banking, Bolton et al. 2019, Carletti et al. 2020, Bolton et al. 2021. Another main challenge is technological change. The agents, institutions, and markets performing financial functions have historically been quick to adopt new technologies, in particular computer and information technologies. It is therefore no surprise that the financial industry is one of the most disrupted by digitalization and new techniques to process massive amount of data. This is testified, for instance, by the proliferation of Fintech offering new payments or intermediation services. Figure 1 displays the growth of the investment in Fintech. The fourth report in the Future of Banking series, Duffy et al. 2022, contains three broad messages. A first idea from the report is that it is possible and desirable to develop a modern, interoperable, and efficient payment system based on bank deposits. The development of a central bank digital currency, CBDC, technology should be targeted primarily to overcome market failures and should not be rushed without careful thought. A second idea is that the increasing use of consumer data allows for efficiency gains but also involves potential risks in terms of privacy issues, diminished competition, and potential increased income inequality. A third idea is that the electronification of market securities has policy and economic consequences that should be addressed. Payment system disruption. With the primary goals of improving the efficiency and inclusiveness of their payment systems, most central banks are now exploring the development of CBDCs. Many are also grappling with other fintech payment approaches, such as stablecoins, neobanks, and fast payment systems, which are based on real-time gross settlement of bank-railed payments. CBDCs have several potential benefits, such as improving the efficiency and competitiveness of payment systems and fostering financial inclusion. However, the report argues that in many countries, especially the US, it is premature to commit to deploying a CBDC. The costs and benefits are large and will remain uncertain until revealed by technology and policy exploration. The greatest challenge for the design of a CBDC is how to protect privacy while controlling money laundering and illegal activities. At the same time, policymakers should explore the appropriate role and regulation of novel payment arrangements, increase the reach and interoperability of fast payment systems, and regulate to foster greater competition in the bank payment system. Digital currencies may have disruptive effects for regulated banking institutions, especially to the extent that they affect funding costs and potentially impair credit provision. However, it is early to jump to conclusions here. The design of CBDCs is not settled. Furthermore, the implementation of a CBDC has an international dimension that may disrupt domestic monetary systems. It has been argued that with wide use of CBDCs, any national currency will be as easy to use in cross-border payments as any other, and that this may erode the dominance of the US dollar and reduce transaction costs. Yet, if CBDCs are not directly interoperable, multi-CBDC bridge arrangements would be required. Auer et al. 2021. Data measurement and data valuation. Data is another policy issue that is prominent for technology-based financial services provision, and one that calls for specific assessments and policy recommendations. The growth in the amount and diversity of data, coupled with progress in artificial intelligence, egg machine, and deep learning, is considerably reducing the cost of acquiring information. Goldfarb and Tucker 2019. The report analyses how data-driven decision-making and new data technologies offer the promise of extraordinary efficiency gains, but also threaten our economic and social order. Data can alleviate mismatch problems that lead to finance being directed to poor ideas, resources being stockpiled where they are not needed, and goods sold to consumers that would value other products more. Resolving such mismatches can unleash a powerful productivity boost. However, firms' use of data also risks compromising consumer privacy, leaving them vulnerable to manipulation. It risks fueling monopoly power, which erodes consumer surplus, and it further exacerbates income inequality, which may undermine support for liberal democracy. There are no easy answers to resolve these trade-offs. However, any thoughtful approach must be grounded in measurement. Data measurement is no easy task. We propose a variety of data measurement approaches that can be employed to gauge the quantity, private values, and social welfare costs and benefits of modern firms' use of data, technology, data, and trading in securities markets. Developments in information technology have changed the form in which security markets share risk and discover asset values. In particular, securities trading is increasingly taking place on electronic platforms run by for-profit companies that, like other fintech firms, use algorithms to match buyers and sellers, develop innovative pricing schemes, and monetize the massive amount of data generated by trading activity on their platforms. Overall, this evolution has intensified competition between trading platforms and between securities dealers, resulting in lower trading costs for investors. The report identifies 4 areas that deserve policymakers' attention. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.